All right, welcome back. We're now going to continue looking at disposals by essentially applying our three-step process and the knowledge that we got in our previous session and applying that to an example. So we're going to have a look at an example now called Mrs. Kemp. So Mrs. Kemp purchased a motor vehicle on the 1st of April 2005, costing $22,000 and depreciates the asset 20% reducing balance basis with proportionate depreciation in the years of purchase and disposal. So what we need to think about in the year of acquisition and in the year of disposal, how long we held the asset for in terms of how many months. That's what we mean by proportionate depreciation. Mrs. Kemp sold the motor vehicle for $8,000 on the 1st of July 2009. Mrs. Kemp has a year end of the 31st of December each year. So remember, the year end is always very important. Let's have a look at the requirement. The requirement says, show the journal entries to record the disposal and complete the disposals ledger account, and then calculate the profit or loss arising on disposal. Okay, so lots of things to think about there. Now, the first thing we need to think about is how we calculate the profit or loss on disposal. So let's have a look. We can see then, and if we remember, that the profit or loss on disposal arises when we compare our sale proceeds to the carrying value of the asset at date of disposal. Okay, and the difference between that will give you a profit or loss on disposal. So let's see what information we can get from this then. Well, they told us that the motor vehicle that Mrs. Kemp sold was sold for $8,000 on the 1st of July 2009. So, sale proceeds, $8,000. Now, we know our disposal date is the 1st of July 2009, but we need to find the carrying value. Remember, the carrying value is the difference between the cost and the accumulated depreciation. Well, we know the cost of $22,000, but we don't know what the accumulated depreciation is up until the 1st of July 2009. So we're going to have to do a little working for the carrying value at the date of disposal, and we'll do that just underneath. So, carrying value at date of disposal. What we're going to have to do is work out the carrying value using that little list that we did in earlier chapters, particularly when we looked at depreciation. So as always, we're going to start off with the cost of the asset, and the cost was on the 4th of April 2005, and we purchased it for $22,000. And so we purchased the asset on the 1st of April 2005, and we're disposing on it on the 1st of July 2009. So we've got several years' worth of depreciation that we need to accumulate along the way. So if we look then, we're doing proportionate depreciation in the year of acquisition and disposal. And we know our year ends the 31st of December. So 31st of December 2005 will be our year end. And we depreciate as an adjustment on that year-end date. Now, with proportionate depreciation, we're pro-ratering the annual charge, and the annual charge was 20%, reducing balance, so that would be on the carrying value, which is the cost. And we're going to pro-rata it for the number of months we've held the asset, and in April 2005, April, May, June, July, August, September, October, November, December, 9 months. Okay, so we've held that asset for 9 months up to the 31st of December 2005. So let's depreciate. 22,000 at 20% will give us 4,400 for the year, but we only want 9 months worth of that, so 3,300 will be our depreciation charge that year. Now at this point, I always find it useful to work out the accumulated depreciation rolling balance. That's going to help us later on when we look at the various the three-step process for accounting for the disposal. So I'm just going to do a little column next to it called accumulated depreciation in dollars. And as we charge more depreciation, the balance on accumulated depreciation will increase with it. 3,300. Okay, and we're going to roll that up as we go. Anyway, carrying value then at the 31st of December 05, that's going to give us 18,700. Remember, we want to work up to the date of disposal, the 1st of July 09. So we shall proceed. Our next year ends the 31st of December 06. We're going to charge depreciation on the asset, 20% reducing balance. And we're not disposing of the asset until 2009, so we would have held the motor vehicle for a full year. So a full year's charge would apply at 20%, should give us 3,740. Now, thinking about my balance on accumulated depreciation for a moment, we already have 3,300 sat there. We're going to add to that the 3,740, and that's going to give us accumulated depreciation at December 06 of 7,040, so 7,040. So you can see the balance on accumulated depreciation is getting greater the more depreciation we charge. Moving on then, we'll get to our carrying value at the 31st of December 06. Carrying value, 18,700 minus 3,740. So $14,960 will be the carrying value at that point. Continuing on then. Next year end is the 31st of December 07. We're not disposing till 2009. So depreciation at 20% of the carrying value 14,960. It's going to give us 2,992. And I'm going to add that to my rolling balance of accumulated depreciation. I have 7,040 sat there. Add 2,992. That's going to give us $10,032. Okay. Carrying value 14,960 minus 2,992, 11,968. And that's our carrying value at the end of 2007. Do 2008 then. Same sort of thing again. At the year end, December 08, depreciation at 20% of the carrying value because it's reducing balance is going to give us 2,394 for a rounding. And if we add 2,394 to the balance of accumulated depreciation of 10,032, that's going to give us 12,426 accumulated depreciation at that date. Carrying value, 31st December 08, 11,968 minus 2,394. It's going to give us 9,574 as the carrying value at the end of December 08. Now, they said it's proportionate depreciation in the year of acquisition, which we've done, and in the year of disposal as well. Now, the year of disposal is 2009, and we've held the asset up until the 1st of July 2009. So in 2009, then, we only held the asset for 6 months. So we can only depreciate the asset for 6 months up until the date of disposal, and then obviously we would dispose the asset at that point. So we're going to have to prorate the depreciation charge once again. So this time it will be at the 1st of July 2009, okay, the disposal date. The depreciation charge will be 20% of the carrying value at that date, but prorated for the months of 2009 that we want to depreciate for, which was 6 months worth. So that's going to give us 957, rounding to the nearest dollar, as our depreciation charge for those 6 months that we held the asset in 2009. And add that 957 to the balance of accumulated depreciation of 12,426. That's going to give us 13,383, the balance on accumulated depreciation at the date of disposal. So, carrying value then on the 1st of July 2009, the date of disposal, 9574 minus 957 will give us 8617, and there we are. So we've calculated the carrying value then at the date of disposal, and really practicing our technique of calculating reducing balance depreciation. Now what we can do is use this 8617 in our profit or loss calculation. There we go. So, carrying value at the date of disposal, 8617. All right, so difference between those two then will give us a profit or loss on disposal, and that's going to give us a negative 617, the proceeds minus the carrying value. So what do you think that is? Have we made a profit on disposing that motor vehicle or a loss? You're all shouting to me, Natasha, it's a loss. And you would be right in thinking that it is indeed a loss on disposal. Remember how I said the figure that drops down at the bottom, if it's negative, it is a loss. We sold it for less than its carrying value in our books at the date of disposal. So, now we know what's happening. We know we've got a loss that we need to deal with and account for. And essentially, we've calculated all the figures that we need. So now what we need to do is do our disposals journal. Step 1. Can you all remember step 1? Step 1 is to remove the cost. So, to remove the cost, then the original cost of the motor vehicle was $22,000. That would have been sat on the debit side of the motor vehicle's cost account. So to remove it, what do you think we're going to do? Debit or credit? Of course, it's going to be a credit to reduce down that asset. So we're going to credit motor vehicles cost account with $22,000 being the original cost of the asset sat there in the cost account. Now remember, if you can remember one side of the journal entry, the opposite side will always be disposals. So we're going to debit disposals to make the double entry work with that same amount of 22,000. Step 1, done. So, now we move on to step 2. You all remember step 2? Step 2 is to remove the accumulated depreciation. If you no longer have the motor vehicle, then you can't have accumulated depreciation on a vehicle that doesn't exist in your business anymore. Now, accumulated depreciation will sit as a credit balance in your statement of financial position. So therefore, to remove it, you've got to do the opposite. You must debit motor vehicles accumulated depreciation account. How much would you remove? Well, we calculated that figure, didn't we? You'll see our accumulated depreciation up to the date of disposal was 13,383. That would be sat on the credit side of the accumulated depreciation account. We need to get rid of it. So 13,383 is what we are going to debit our accumulated depreciation account with. So, our credit entry then, if you can remember the debit, the credit must go to disposals with the same amount, 13,383. Don't worry, we're going to see the disposals account in a bit more detail. Okay, for now we're just doing the journals. So steps 1 and 2, you're removing the asset from your books. Step 3, step 3 is to deal with your proceeds. You've received $8,000 cash from disposing of that asset. So we're going to, of course, debit the bank account with $8,000, the proceeds from disposing the motor vehicle, and then credit disposals, because this is a disposals question. The corresponding entry has to go to disposals. And there we have it. There's our 3-step process now complete. So, finally then, let's post all these transactions to the ledger accounts. So, we're going to need a ledger account for the motor vehicle's cost, for the accumulated depreciation, and we're going to want a disposals account. We're just going to ignore the bank account because, again, looking at the bank account is not the point of this example. So, as you can see, ta-da, I have my ledger accounts already prepared. Again, feel free to pause the recording to draw up your own T accounts. But now what we're going to do is proceed to complete these T accounts. So, motor vehicles cost is what we're going to start off with. Remember, that's an SFP account. What we need to think about is the position of these accounts before the disposal. Now, at the date of disposal, we know what the cost is, we know what the accumulated depreciation is that we need to remove, so therefore it must be the opening balances. Now, if you're ever given an opening balance or a balance brought forward, that dead click mnemonic that I talked about will always apply. So if you have an opening asset, remember assets appear under the D in dead click, which stands for debit. So, on the date of disposal then, we would have brought forward an asset cost of $22,000. Okay, that would have been carried and brought forward for the whole life of the asset up until the date of disposal. It's an opening asset. We're also now going to open up accumulated depreciation account. So motor vehicles accumulated depreciation. Remembering also that is an SFP account. And again, that's the opposite to the motor vehicles cost account. Okay, so it reduces the asset value. It's going to be a credit balance brought forward. And that credit balance brought forward, we said, was 13,383. That was all the depreciation that had accumulated on that asset up until the date of disposal. That's our opening position. Now we have those opening balances in. Now let's proceed to do the journals. Step 1 was to remove the asset cost. And we said we were going to debit disposals and credit non-current asset cost or motor vehicles cost. Let's just do the credit first. I'm just going to write here 1, so it reminds you that it's step 1 that this is coming from. We're going to credit the cost account and take the debit to disposals, $22,000. Notice then that would leave no balance on your ledger account. That motor vehicle is now gone. We said the debit was going to disposal, so we're going to have to open up a third ledger account called disposals. There we go. So, disposals, with step 1 being the motor vehicle cost of 22,000. So that's step 1. Step 2 is to remove the accumulated depreciation. We said we were going to debit accumulated depreciation to clear it. So step 2. Our corresponding entry will go to disposals with the amount that we need to remove the accumulated depreciation on the disposed asset, 13,383. Notice that account balance is now, there is no accumulated depreciation left. The credit entry will go to disposals. So, accumulated depreciation on that motor vehicle, 13,383. Okay, so that's steps 1 and 2 done. Step 3 is to post the journal for the proceeds. So we said we're not going to bother with the bank account, but if you did, you can open up a T account called bank and debit it with $8,000 proceeds. We'll just do the credit to disposals, being the cash proceeds, or you can call that bank, 8,000. And that would be your 3-step journal done. Now we've balanced the cost account, we've balanced the accumulated depreciation account, they're done. Now we've just got to balance disposals. Can you all see then that the debit side is higher than the credit side? Not by much. So, balancing this off then, you should find that you have a balancing figure, if you tot it all up, of 617. Does that look familiar? That's the loss on disposal. And that loss on disposal is an expense to the statement of comprehensive income. Do you remember when we did the depreciation expense account? And what we did is when we did our write-off to the statement of comprehensive income, the amount that we wrote off was on the credit side. If you don't remember, go and have a look back. But the write-off was on the credit side. So if you have a write-off on the credit side of the disposals account, it's a loss. And a loss on disposal is an expense. All right, so a loss on disposal is an expense. And you would see that as your balancing figure on the credit side. So look, I'm not carrying forward or bringing forward. I'm writing it off because it's a loss. It's an expense in 2009. Conversely, if it was a profit on disposal, that would appear on the debit side. And that would be income. And again, that income would be written off to the statement of comprehensive income. It would be other income or sundry income in the year. It would increase your profits. Now, obviously, that's nil. But if you do find the balancing figure is on the debit side, that is your profit on disposal, and that would be income to your income statement. Now, this is a bit of a long-winded way of getting to the profit or loss on disposal. But we already calculated that figure earlier on. So if your exam question says, calculate the profit or loss on disposal, you don't need to do the T account to work out the missing figure. You can do that little pro forma calculation that we did above. But it's important that you know the journals and the way it's treated in the ledger accounts, because you do need that, particularly in later sessions, maybe when you're correcting errors. So, that's disposals complete. Thank you.